Hello everybody, welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Josh is out this week and I'll be solo. I thought I'd talk a little bit about what in the heck is going on in the stock market the last 3 months and month relative to what's going on in the U.S. economy. I know a lot of you are wondering, you're seeing what's going on in the economy continues to slow, and so why are stocks up? In the month of January, the S&P 500 was up essentially a little over 5.5%. Small and mid-cap stocks are up between 7.5% and 8%. International markets are up over 8.5%. The NASDAQ was up 10% in the month of January. So what's going on if the economy is continuing to slow and we're all seeing it in our day-to-day lives? Why is the stock market up so much? We've been getting a lot of questions from clients in the month of January, what we think 2023 has in store for us. And so I thought I'd address that in this e-news. We really believe that this continues to be about a duration story. Remember, we have just seen the fastest increase in interest rates we've ever seen. We're still at relatively low interest rates historically, but the Fed's going to probably raise rates by 0.25% tomorrow, and then give us some guidance about what they think for the rest of the year. The reason the market has traded higher so quickly is because the market believes the Fed is going to stop raising rates sooner and then potentially in the second half of 2023 cut rates. And that's why you've seen the riskiest of the risk assets trade up. I mean, a lot of the stocks in the NASDAQ that were down 50, 60, 70, 80% have rallied sharply in the month of July, thinking things that are going to, quote, go back to normal, meaning normal being a very low interest rate environment when all that matters was owning growth stocks. We don't happen to be in that camp. We disagree with the market and market participants thinking things are going to go back to quote unquote normal. We think things are going to go back to normal, meaning prior to 15 years ago when interest rates were higher, companies that actually made money, their stocks went higher, and companies that were bleeding money every month eventually went bankrupt. We think that's the normal. We're going back to a higher interest rates for longer period. We think that even if the Fed pauses raising interest rates after 1 or 2 more rate hikes, we don't think they're going to be cutting anytime in 2023. So we continue to believe that this is a duration story, meaning higher interest rates is going to take a while to filter through the economy and all asset prices. All asset prices are being repriced, whether it be stocks, bonds, the housing market, commercial real estate, all of those assets are being repriced with a higher interest rate environment. It doesn't mean that stocks and all those risk assets can't go higher eventually, but they're having to be repriced. And we continue to see a lot more volatility in all of those markets in 2023. So we are mentally preparing for more volatility in 2023. We think you should as well. If stocks go higher and the worst is behind us, great. But we don't happen to be in that camp. The good news is we saw fourth quarter GDP, the U.S. economy grew by 2.9%, which was better than expected. Earnings season for the fourth quarter has started. We have about a quarter of the companies in the S&P have reported, and earnings are decent so far. But we think, again, it's going to be a duration thing where this is going to play out much like we saw in the early 2000s. Remember 1999 when stocks got really overpriced. The Federal Reserve raised interest rates 6 times, and then the market finally rolled over. And the high growth tech names that were in the NASDAQ went down 82% in that market. We don't know if that's going to happen again, but we think there still needs to be a lot of repricing in those tech names and really overpriced stocks. The market doesn't really believe that. Market thinks that the Fed is going to chicken out and cut rates sometime this year. And if that's true, maybe those stocks do go higher, but we think our portfolios, your money is set up to be positioned. If stocks rip higher, we're in a good place, but if stocks trade sideways, when we look at our diversification is finally working international is working, small is working, the bonds we own are working, and so we continue to believe our portfolios are in a good position going forward. Remember, the other thing that's important to remember in a volatile market is that everything we own is paying a dividend. Those dividends are being reinvested in most cases, and that when stocks do start the next bull market, you're going to own a lot more shares that will propel the growth of your portfolio. So I think my point in this is we aren't buying this rally we've seen in the last month and a half. It's been nice, obviously, to see portfolios go back higher, but we think mentally you should be preparing for more volatility in the year ahead. As always, if you have questions about your situation, your portfolio, your account, give our office a call to schedule an appointment. The number here is 800-743-0988, or you can send me an email at tyler@northwestquadrantwealth.com. I'll see you back here in 2 weeks.